Bob Iger holding his first town hall since returning to the CEO position at Disney. During the private event, Iger took questions from employees and confirmed the hiring freeze laid out by his predecessor. He confirmed that that will stay in place. He also said the company needs to focus on making its streaming business profitable. Shares at Disney closed down over 3% today. There's also a headline that just crossed on Bloomberg saying that Shanghai Disneyland will be closed starting on Tuesday. Jeff Mills, a lot going on with Disney. Do you like this CEO? Do you think that the 3% move today was just overall markets dragging it down? Do you think there's a concern about China? What was behind that?
I mean, I think it's a little bit of both. You have to attribute some of it to China, but I think, overall the stock has been pressured since its last earnings release. But, overall, I like Bob Iger. I think he has a track record here. I think maybe figuring out where some of the content goes in terms of its platforms, cutting costs, like you mentioned. But I did like hearing the discussion about profitability during the town hall today. I think that's super important. So whether you're talking about the ad-based tier generating a higher revenue per user than the ad-free version, whether you're talking about an increase in subscription fees, I think all of these are very important, even if it means slower subscriber growth. So I think next quarter will be very telling. I think we'll see some of that impact in December. But overall, the question in my mind, I think the question in the market's mind is, does this focus on profitability pull forward that 2024 Disney Plus profitability estimate? I think that's the key. Having streaming become cash flow positive is very important. Can the company finally start paying a dividend again? That's key. The stock is at the same price it was February of 2015. And back then it was trading at 20 times forward. Right now it's trading at 22 times forward. So what is the right premium for streaming? I think that's another really important question. It's certainly not 40 PE turns, what it was in 2021, but 2 seems reasonable to me. So there's certainly the possibility for near-term volatility, but the valuation seems okay here.
Yeah, when I first saw the headlines cross coming out of the meeting, it was like Iger focuses that the company is going to focus on creativity, which made me think, oh, lack of a focus on profitability. But then, Jeff, what you had talked about came up, and that's basically giving up this dream of growth at all costs for the streaming side of the business, which had been the mentality for a lot of these services that had started up. So with that out of the way, Disney seems like a much more stable on a more stable trajectory in terms of profitability. Karen, what do you think of the changes here? What came out of the meeting?
Growth at all costs is a lot more expensive than it used to be.
Yes.
Because of debt, right? And they are not without debt from that Fox acquisition going back, I don't know, 3 or 4 years already. I think, for morale, that's something that's really important that he's back. But I think that Chapek also wanted to get to profitability. He was willing to spend more on streaming, but for the rest of the businesses, he really did want to, he really wanted to improve the businesses. I don't know. I feel like this valuation here, it's fine. It's a premium. It deserves somewhat of a premium. They are Disney. But I think that there's still a lot of work to be done. Mm-hmm. And I don't know that, the whole space, particularly the streaming space, that is, the whole space is really under a complete revaluation. I don't know who's going to survive. I think there'll be some consolidation. I don't know that Disney's not going to be consolidated. They'd be the consolidator, but I don't know that they're in a position to do that right now.
Yeah, and he said he's not going to sell to Apple, which I thought was kind of interesting. So it must have been a question about that. And let's see if they actually made a bid, if he would say no. I don't think so. But, this is also probably has to do with the box office. It was really bad. They had a big release this weekend of one of their animated shows. I'll just say this about what they did on the content front as the launch of Disney Plus. I mean, they put out a lot of great content over the last couple of years from Marvel, from Lucas, from all those sorts of things. And they probably did what they needed to do to establish a beachhead and compete with Netflix, which was known for that. It was also an arms race when you think about what Apple is doing and Amazon and Hulu and some of these other streaming networks. So I think that investors should be happy that this guy, who was the original architect for all of this plan, is now focused on kind of fixing it or getting it to the next stage. And I'll just say this, the night that we had the deal announced, or we were talking about it on Fast Money, I think all of us were like, it probably goes lower with the market. I don't think it probably acts worse than some of the names in the space here, but this stock will have an 8 handle on it again and could go back to those March 2020 lows, which was somewhere just above $80.